Right, so in this video, in this lesson, we're going to be looking at the cash receipts journal and then looking at each of these can I say folders or line items, so that you can understand them, and this makes it easier to record any transactions, right? Once you understand what the analysis of receipts, bank, receivables control, sales, and VAT. For VAT, this is VAT output, right? So each time you sell something, it will be VAT output. Every time you buy something, it is VAT input. So think of it as a process, right? And I covered this in the previous video on VAT, right? So when you buy things, let's say you're buying raw materials, that's an R, right? And then this is you, the business. When you buy things, they're coming into your business, right? So that is input, right? They're coming into your business, that is input. When you sell things, they're going out of your business. So these are all your customers, little hits there. This is output. You're selling something, so that means the final product is leaving your company, is going out of your company, right? So customers there. So that's how you think of VAT input and VAT output. If it's very confusing at the beginning while you're still trying to learn it, but if you can understand this example, shall I say, then the input and output part is fairly simple, right? So yeah, I want to cover each of these, so that you understand how they work, and then when you have to record a transaction, it's much easier for you to do, and you don't need to think about it that much, right? So starting with the doc, the doc means the document. What is the source document? Where does it come from? Right? So if you sold to a credit to a debtor, if a debtor is paying back, is paying you, it would probably be a receipt, right? A receipt for you giving them for the cash payment, right? If it is a till slip, the one that we see at ShopRite, and then when you buy, they give you a till slip with the VAT inclusive and VAT exclusive amounts and all that. That is, from a business perspective, is the cash register roll, right? I think we've all been in that situation where you're at the till, you wanna buy, and then the roll finishes, or it finishes, then they have to replace it. That roll, in accounting, we consider that the cash register roll, which is what we look at when we're recording transactions that come from the till, right? So in ShopRite, each time each of us buy, then it's cash register roll 1, cash register roll 2, cash register roll 3, and so on and so forth, right? So debtors get a receipt, and the cash register roll gets the till gets a cash register roll. Now when you put in capital, what would that be, right? That will also be a receipt, because remember, you're putting in money. Now you need proof that you put that money in, right? If the SARS capital contribution is coming from the owner of the company or the business, right? And if SARS now comes to the owner on a personal capacity and says, show us your transaction and sales and proof of these transactions, then now as the owner you can provide the receipt to say that I contributed 10,000 into my company, or whatever the case is, right? The day is just the day. The day is just the day, that nothing changes there. The actual day that the transaction happened. The details is either the name of the person who did the transaction. So usually when it comes to the debtor, it's their actual name. And then when it comes to the cash register roll, you just say sales, And then for the capital, the receipt, it's either the name of the owner, right? So if you are putting money in your own company, say I'm putting money into my own tutoring company, it would say Bongani Mashangu in the details. And then yeah, or you can say bank, the bank where you deposited the money in, right? Another thing is when a debtor pays you. Yes, we've covered that. Yeah, yeah, sorry, no, yeah, this one is the name only. Yeah, not the bank, not the bank that gives you, not the bank that you deposit the money into, right? Analysis of receipts. Now, this one is also you looking at your receipts, right? Your receipts from the cash register roll. So here, when you look at those, so think of it as you in ShopRite and you're looking at your till slip. When you look at your till slip, you know how much you paid, how much VAT is there, and all that good stuff. Same thing with analysis of receipt. You as the accountant of the business, now we're doing it the perspective of accounting of the business. You as the accountant, you're gonna look at each till slip in a figurative way. You can't do that, the systems, but you're looking at each till slip and you're saying that this is how much was put in there, this was how much the customer spent, this is how much we made for each particular sale, right? So analysis of receipt works with till slips, with cash register, or with physical sales that we make, not with debtors receipt not with debtors that pay us, not with any capital contribution, not with any loans that we get. No, only with this. So this is analysis of receipts. I'm gonna run out of space here, right? Your bank just a shortcut, just to let you guys know, your bank will always be affected no matter what, right? No matter what you're doing, your bank account is going to be affected, because if you think about it, if a debtor pays you, that money goes way into your bank account, right? The business bank account. As a whole business owner, you're not gonna put money under your mattress in your bed, right? Remember, now you're thinking as a business owner. So if you're selling in Gauteng, or let's use me as an example, I am tutoring in Gauteng, right? In Gauteng, and someone is paying me from KZN. How would they do that if I don't have a bank account, right? They're paying me. How would that happen if I don't have a bank account? So it's the same thing here. Everything that happens in the business will go through the bank account. Hence, this is one of the most important the most important accounts in the business. And for me, preferably, when I'm trying to understand, and when I was, past tense, when I was, now I do, when I was trying to understand how the whole journaling, no, not general, the ledgers, how does that work, what is debit, what is credit, what is all that, I would use the bank account, right? Because from the bank account, all of these accounts get affected. Bank account is an asset. When money comes in, owner's equity, right? Double entry rule. If one thing gets debited, the other thing must get credited. So if the bank gets increases there, if I'm contributing capital, that means it's going to be the opposite, right? If bank increases there, and I took out a loan, that means the loan must pay up the money in my bank account, right? So that goes there. And then the opposite is true. The moment I start paying back my loan, the loan amount that I owe decreases, right? If asset is there and bank is positive, that means income, money that comes in, is positive on the credit side, right? So this is credit, this is debit, right? Will increase on the credit side. If um bank decreases on the credit side, that means my expenses will increase on the debit side, right? So the more I pay, the less money I have, right? The more I pay, the less money I have. Using the bank account to understand everything. So once you have that, then you know how this forms. But we can cover that in a different video, right? So just in a nutshell, what I was trying to say is that the bank account is very important, and everything happens here. So going back to my example, remember now we also have VAT, which we must accommodate and understand. So going back to that example of mine, when someone pays me from KZN, the money that comes into my bank account is the full amount, right? It's like when one of your friends pays you or borrows you 200 rand, the money that goes into your account is the full amount, right? So say they pay me 200 rand, it's going to be the full amount. But remember, I'm working as a company, as a business, right? And I have to pay this little thing named VAT, right? So because I have to pay VAT, when I record this within the business, I will then say my VAT has to be accounted for, right? My VAT has to be accounted for. I'm using rough numbers. Let's say the VAT is 30 rand here, right? That is the VAT amount. Then I need my VAT exclusive amount. So I have my VAT inclusive amount, which is the total for bank, because that's the money that actually came into my account. I can't make this the VAT exclusive amount, right? Then finally we have our VAT in exclusive amount, which is gonna be sales, right? Remember, this person paid me from KZN for my tutoring services, so the sales here is gonna be the VAT exclusive amount of 170, right? Once again, I touched on VAT in the previous video. You can go through that to recap and understand, but just a little go back there, draw back, because we need to keep on referring to this as it's important to understand. VAT inclusive means the VAT amount is part of this amount, right? And this will always be 115%. VAT is just VAT, right? At 15%. Then we have our VAT exclusive amount. So this is the amount without VAT in it. And this is 100%. There's a whole breakdown. If you don't understand this, there's a whole breakdown in the previous video on VAT as to why is exclusive 100% and inclusive 115, and how VAT works and all that. So if you don't understand this section, I suggest you pause and then go back there, because it's just gonna get confusing, right? So as I was saying, bank will then be always and forever VAT inclusive amount. So if they say that J something paid 200 rand to you, you're gonna record the full 200 rand in your bank account, right? So this is VAT inclusive. Always remember that. Then trade receivables control. This is money that you receive as the business from your debtors. Debtors are people that owe the business, that owe the company, right? Please remember that. Please don't confuse this with trade payables control. Trade payables control, listen to the name, payables control. These are people you have to pay, meaning that you owe them. These are your creditors, right? So trade receivables control are your debtors, and they pay you, right? Please always and forever remember these things. They're a bit confusing at the beginning, but but the more exercises you do, the more the easier it becomes, right? So your trade receivables controls, I'm just gonna abbreviate it here. Trade receivables control is also a VAT inclusive amount, right? I'm gonna do this line by line, and then at the end I'm just gonna sum it up so that you can understand. But here I just want to break it down and try to make things simpler. So trade receivables control is a VAT inclusive amount. Remember, VAT inclusive amount is 115%. It's the full amount. So if they say that once again, J something paid that 200 rand towards you, right? Paid 200 rand to the business, you record the full 200 rand in trade receivables control and the full 200 rand in bank, so that you know that's the full amount that you received. Now to the fun part, sales, right? Now we're doing sales. Sales is whenever you sell something. So as I said here, sales, cash register or till slip, right? And sales will always go with analysis of receipt. But don't forget, you also have your bank. You also have your bank. That is the money that you receive. Now, in sales, I'm going to repeat it again. Sales is when you sell something to the customer. So, ShopRite would record sales as when each and every one of us go through the till and we pay. Me as a tutor, I will consider a sale as whenever I have a one-on-one tutoring session or a group session and someone pays me, let's say for argument's sake, it's 50 rand. They pay me 50 rand for my tutoring services. I will record that transaction as a sale, but I don't record the 50 rand as sales, right? So let's make the example here. Bongani, I don't know why I said it like that. I feel like whenever someone says Bongani like that, I feel like I'm in trouble. So Bongani tutored for, let's make it a round number. Let's make it, no, not I don't want 100 rand. Okay, let's make it 50 rand. Tutored for 50 rand. In no world is my tutoring fees to 50 rand. But yeah, Bongani tutored for 50 rand. Then, now remember, when you record this part, this is one of the most confusing parts of this whole journal. When you record sales, there are four accounts that are going to be affected, right? Why am I doing that? First account that's going to be affected is analysis of receipts, right? Number 2, bank. Remember, you're receiving money. I conducted the tutoring lesson, someone paid me, I gave them a receipt, hence I also have analysis of receipt. Number 3, sorry. Number 3 is sales, right? Because I made a sale, right? I sold my services rendered. I sold my tutoring services. And then number 4 is the VAT output, right? Now, analysis of receipt and bank will be the full amount, the VAT inclusive amount. Where did the V go there? VAT inclusive amount. Same here, VAT inclusive amount, meaning full amount. Whenever I say VAT inclusive, I mean the full amount. Sales will be the VAT exclusive amount, meaning that it is the VAT inclusive amount, the 50 rand, minus whatever the VAT amount is, and that will give us our VAT exclusive amount. Then VAT output is the actual VAT. So how does this look in a practical way? It's going to be bank 50 rand, right? Analysis of receipt is also going to be 50 rand, right? Then sales Okay, let's skip sales for a second. VAT output. VAT output, we then are going to say 50 Rand multiplied by, remember the 50 Rand is the VAT inclusive amount. So we're going to say 15% over 115 Rand. Don't know where this equation is coming from? I urge you again, go back to the previous video. I show you how to calculate and how this works, right? So put that quickly into your calculator. 50 multiplied by 15 over 115, and that will give us 6,52. We're rounding up to 2 decimal places, right? So our VAT on this sale is 6 Rand 52 cents. Then to find your VAT exclusive amount, you're gonna say 50 multiplied by 100 over 115 equals to, over 100 115, it's going to give us 43,48, right? If you do your maths and say 50 here minus the 6 Rand 52, it will give you the 43.48, right? So that is how we do that. That is how you record a sale coming from the cash register or coming from the till, right? Please you must understand what goes where, right? The bank represents 115%. That's the VAT inclusive amount, 115. The sales VAT exclusive represents 100, and the VAT output represents 15%. Please remember this. Don't understand this, go to the previous video. But here I just want to show you how it looks like, right? Then your sundry accounts. Your sundry accounts is really it's not a dump. It's an everything else column. Let me call it that. Everything else. So if you have a transaction that does not fit in any of these columns, if you have a transaction and it doesn't fit, remember that these two are the, why did I do that? These two are the basis columns, right? So remember okay, no, not these two, just bank is the basis column, because analysis of receipt is just you looking analyzing the receipts, right? Bank is the column that will always be there regardless, but it requires a contra column, a contra account. So it's either bank and trade receivables control, or bank and sales, or bank and VAT output. Well, some of these work in conjunction, but that's another thing, right? So it's bank and so it's bank, sales, and VAT output together, right? Or bank and trade receivables control. Now, if you have a transaction whereby whatever you're recording does not fall under trade receivables control or sales, then you would take it to the sundry account. Remember, we don't count VAT because VAT works in conjunction with sales. Sorry if I misled you there 2 minutes ago, right? If it doesn't fit into trade receivables control or sales, it would come to the sundry account. Now, to give you an example of what could come here is under the sundry account, you could have capital contribution, which is literally capital. The detail, you write capital, that is the account, capital. Or when you've gained a loan from the bank, when they've given you a loan, remember, think logically, right? Accounting is a logic subject, so you must reason with yourself sometimes. If you don't understand in the test or exam, reason with yourself, chances are you're gonna come out with the answer. If I take out a loan, before I start paying it, that first day when I take out a loan, the bank deposits the money into my account. Hence, the loan comes into the cash receipts journal. I'm receiving the money. Before I pay any installment, first I receive the money. I receive the lump sum amount. It comes in. Then I start paying. So we're not concerned with the paying part, we're just concerned with the lump sum that comes in at the beginning. Hence, the loan comes as part of the cash receipts journal, as sundry, right? As its own thing. And that also goes into details like that. Both of these are VAT inclusive. Right? Now, if you've been paying attention, I've said only one account is VAT exclusive. Only one. In this whole video, in all of these accounts, only one account is a VAT exclusive, right? And that is sales. Sales is VAT exclusive, right? Right here. Sales, VAT exclusive, right? So I wanted to show you for each column what it is, VAT inclusive or VAT exclusive. But now I'm telling you at the end that sales is the only one that is VAT exclusive, because sales goes hand in hand with VAT, right? Remember, when you sell something, in my example here, when you sell something, you pay VAT. Everything else, you're not really selling. When a debtor pays you, they are paying you, right? You sold before, and then you recognized VAT there. Yeah, let me not go into that. That's advanced stuff. But yes, right? You sold there, you paid VAT then. When you contribute capital, this I haven't learned fully, so I'm not gonna lie to you guys. But I don't think it would make sense to pay VAT or tax on an investment, right? Yeah, I think that's how it goes. And also a loan, same thing. So the only thing that is not VAT inclusive is sales. Hence, because not a hint, right? It's bank, which is VAT inclusive here. Then it divides into two: sales and VAT output, right? VAT output is the actual VAT amount, and sales is the VAT exclusive amount. But when you add these two, they're going to give you the VAT inclusive amount. I've been saying inclusive and exclusive so many times that I'm getting confused, right? They will also give you the VAT inclusive amount. Look at everything else, it's just bank and that account. So capital, it's bank and capital, and they're both VAT inclusive. So in the end, we want both sides to balance, because that's accounting. We need to balance the debits and the credits, right? But in the case of when you sell goods in your sales, that's how it works, right? I hope this makes sense. Before you attempt activities or anything, please understand how each of these work, where the VAT exclusive part comes in, how to calculate that part and all that. Understand that, then go try it out. If you are not able to get, say, 60% correct, come back to this video, look at the parts where you don't understand, and if you still don't, pop a question in the comment section, right? I will attend to it as soon as I get time, and hopefully we can resolve any confusion that you have. Then in the next lesson, I'm gonna do a practical example of this, so that you can see what goes where and how everything is treated.